Germany's economy is growing, but do not mistake this for a broad-based boom. On Friday, August 28, 2026, Commerzbank published fresh analysis showing GDP expanded by 0.3% quarter-on-quarter in Q2, revised up from an initial 0.2%. That is an important detail because it confirms 3 consecutive quarters of roughly 0.35% average growth. The puzzle is that this momentum is not coming from German firms investing at home. It is coming from exports, especially to EU partners, while private investment remains weak. In plain terms, Germany is being pulled along by demand from neighbors rather than pushing forward on its own. The past 7 days brought 2 notable shifts. On August 25, 2026, the Federal Statistical Office raised the Q2 growth figure to 0.3%, with President Ruth Brand pointing to export strength. Then Commerzbank's Dr. Ralph Salvin highlighted a solid jump in the IFO Business Climate Index, from 86.7 in July to 88.8 in August. Both current conditions and expectations improved, led by manufacturing and services. Why does this matter? Because business sentiment is a forward-looking signal. When German managers feel more positive, they are more likely to hire and order. Yet Commerzbank notes that government investment, despite special funds, has not risen sustainably. That tells us the public sector is not yet filling the gap left by cautious private investors. For ordinary Germans, the impact is mixed. A robust labor market and resilient consumer demand mean the recovery is being felt in everyday spending. Easing supply chains have supported factories. But the weak private investment story is a warning sign for future productivity and wages. If companies do not invest in machinery, software, and buildings, they cannot expand capacity or become more efficient over time. That is why Commerzbank still calls the recovery moderate despite the GDP upgrade. It is also fragile. Geopolitical tensions, persistent inflation, or a global trade slowdown could quickly hit export-dependent manufacturers. So Germany's current strength depends heavily on conditions it does not fully control. Commerzbank is holding its 2026 German growth forecast at 1%, but its analysts now say there are slight upside risks. The main reason is that Q2 came in stronger than expected and the third quarter looks less weak than previously feared. Yet the forecast has not been raised. That tells you the structural problem is serious. Weak private investment, high energy costs, and an aging workforce all limit how fast the economy can grow without overheating. If EU demand stays solid, Germany can keep expanding moderately. If global trade stalls, there is little domestic investment to fall back on. So the next few IFO readings and investment data will be crucial. The takeaway for Friday, August 28, 2026 is simple. Germany is no longer in recession, and export-driven growth is real. But recovery stays moderate because one engine, private investment, is still not firing. Commerzbank's 1% forecast with slight upside risks reflects that tension. Watch whether business confidence translates into actual capital spending, not just better sentiment. If it does, Germany's recovery could surprise on the upside. If it does not, growth will stay dependent on foreign demand and remain vulnerable to global shocks. That is the key signal to monitor in the months ahead.